Hey YouTube, I want to take a few minutes and explain to you a little known provision in the tax code which allows you to take early distributions without penalties from your IRAs, and then the implications of that on how you save for retirement. If you're not planning on doing a traditional retirement, maybe you want a FIRE or a fast FIRE, or just retire before the government allowed ages of 59 and a half or 65. I found this provision when I was younger, probably 20 years ago, so it's been in the tax code a long time. It's not known widely. I hadn't seen videos on it, hadn't heard about it, so I thought I would share it to you. It's called 72t. Now 72t is actually the piece of the IRS tax code that defines penalties, withdrawal limits, and taxes on money as you take it out of the IRA. So it's not specifically written for this provision, but it has it in there. 72T, one of the things it allows that's not well known is allows substantially equal periodic payments. What that means is that it allows you to take monthly payments of a specific amount for no less than 5 years or until you're age 59 and a half without paying penalties. Now, if you look down here, it defines substantially equal in the amounts. You have to calculate the amount based on one of these three methods, which are based on prevailing interest rates at the time, life expectancy, and your age. But you set an amount based on one of those three methods that you're going to withdraw every month, and then every single month for a minimum of 5 years or 59 and a half, you withdraw that amount of money, and there's no penalties on the withdrawals. Now, that is an interesting, provision that most people don't tell you about. And what that changes is if you're looking at, at FIRE or, fast FIRE or early retirement or retiring at 45, and you were thinking, I need to put 10% into my 401k and 10% in a brokerage account so that I have money for before retirement, before 59 and a half and after, then that allows you to put it all into an IRA, allow it to grow tax-free. And then, at age 50 when you retire, you take those monthly distributions, and it allows you to have all that money, together. Now, there's one additional provision right here, number 7. How can I change from one method to another? So you can. If, let's say, you're using the life expectancy method and you're pulling out $1,000 a month and you say that's not enough, then you can switch to a different method like the percent method, and maybe that changes to $1,500, and you can change that one time in the tax period, until age 59 and a half. So, based on this provision, now it says that when you're saving for retirement or early retirement, as long as your goal is retirement, you can use IRAs as the full vehicle for that retirement. So what's the best type of retirement accounts? Well, first let's talk about, at a very high level, a few that I use, okay? You've got a 401k, you've got a Roth IRA, you've got an HSA, you've got education IRAs, simple IRAs. Now, 401k is probably one of the top ones people use. A lot of times your employers have a match on that, and you pay taxes as the money goes into there, so you can max that account out through your employer and maybe get a match on part of the contributions. The Roth IRA, you pay taxes when you pull it out, or when you put it in. This one you get a tax deduction when you put it in. I said that wrong. So, the Roth IRA, they say, is better because you pay lower taxes. In actuality, a tax of 30% when you put it in, or a tax of 30% when you take it out, is the same. The rules of multiplication say the order of multiplication don't matter. So you start with the amount of money, you multiply every year times the growth rate, and at the end or beginning you put 0.3% taxes, and it's the same result. Okay. Now, what does matter is whether you're in a higher tax bracket now or a higher tax bracket later. The other thing you need to think about is if you have all your money in a pre-tax account or a post-tax account, you don't get to plan based on taxes how much you take out of which account. And that can be an advantage, so you should have some in each type of an account. But if you're in a max tax bracket right now, you may want to put it just in your 401k first, because your taxes are lower or higher now than they will be after you retire. I mean, that may be a thing. Now the best retirement account I found, which is weird, is an HSA, a health savings account. You don't pay tax when you put in. You don't pay tax when you take out. You don't pay FICA on the money in there. It's basically the best type of IRA account that you can have. And when you retire, you could use that account for your Medicare supplemental insurance or medical expenses. Now, I don't know if you've looked at kind of a plan of what it costs to retire, but a large percent of that is medical expenses. So your HSA can allow you to plan for those expenses. Appreciate you being here today. Hopefully I get better, not worse, at videos and sharing some things I know. Hope you can use it, save some money. Leave me a comment or a like or subscribe. I'll add some more content. I'll probably add some more videos on real estate or selling or crypto or some of the other things I've been into lately. I'll talk to you later.